The time-old question, which ETF is best? VT, QQQM, SCHD, VOO, a whole host of S&P 500 style ETFs. Which one's best? A few moments ago, we had a comparison with what's best between VOO and SPY. You might want to wait to the end. I'll give you the link for that. We did a full deep analysis on that one. This one's going to be a lot simpler, lot smaller one, this one. One of my members has asked, here he is, this is RC, one of our members, said, what are your thoughts on VT, QQQ, SCHD, and he also mentioned a few seconds later, can you include VOO in that as well? Well, this often gets asked by people. They want to be fully diversified. And fully diversified, some people think, let's buy everything. Well, it's not really the way forward. And let me explain why. Each of these are ETFs with a basket of funds. They already are diversified. People buy ETFs to make life easier for themselves. They pay a fee to do so. There's a management fee, so you're looking for one that provides passive, not active management, unless you feel it's necessary. Certain stocks, ETFs, do require active management where things move all the time. But if you are a long-term investor and you buy the S&P 500, you're looking for a passive managed fund and pay a smaller fee than an active one. You just don't need an actively managed S&P 500. So look for a good value ETF and then decide what sector you like. You might like a specific sector like tech. You can get a tech ETF. You might like a crypto ETF, pharmaceuticals, whatever it might be. You might like a different sector. And rather than pick the winning stock, you pick a basket of all the best in that sector. That takes away the risk for the individual stocks. I wouldn't suggest, though, doing something like an ARK Invest, Cathie Wood ETF, because the fees are insane. She's there to make money for herself, and it just doesn't make any sense. If you like Tesla or Robinhood, just buy it yourself. Don't buy it as part of Cathie Wood's fund, because the fund was there for her. All funds are there for the management, but Cathie Wood's funds are actively managed and very expensive, and you're just paying them to do what you can do yourself. Kind of pointless. But if you are buying an S&P tracking type ETF, why do you want VT, QQQ, SCHD, VOO, SPY, all of them? You don't, is the answer. You don't need all of them. Being fully diverse doesn't mean owning everything. A index, a good solid VOO is my preferred choice, as I've proven in my last video. That's all you need. And then if you want to buy a few individual stocks just to promote a certain area, you particularly like NVIDIA, or you like space, or you like something like that, you can add that. But to have half a dozen ETFs don't really serve any purpose. And I'll show you they don't really do anything. There's kind of not much point. Look, if you put all these side by side, VOO, how do you do? QQQM, SCHD, we've already looked at SPY, it's kind of the same thing as VOO, but more expensive. You can see they all do the same thing. There's hardly any difference. They all kind of perform about the same. And the numbers all work out the same, except VOO is by far the better performer. As you can see, it's right at the top, orange over here. You can see it at the top because, and the reason why it's at the top, not because it's done necessarily better, is because it's got the best management fee. End of the day, folks, if I buy it myself, it's probably why I like it, because I've done this research on your behalf. I wouldn't buy the others. Now, why do they exist? Why are they there? Well, competition. They're all businesses in their own right. Is a Ferrari or a Rolls Royce the best car in the world? Well, let's just say for argument's sake, Rolls Royce is the best car in the world. Why is there only one company? Let's just sell Rolls Royces. Everyone has a Rolls Royce. Everyone's got the best car in the world. Why would you want the second best car in the world? Well, because businesses compete with each other for your business, and they'll do something cheaper and different to encourage you to buy their business. So that's exactly what this is. They package it up slightly different, and make it attractive, tell you different things, and they hope you buy it. And fair enough. Do you need it as a retail investor? Nope. Pick the one you like, and that's it. Why do you want half a dozen? What does it benefit you? Well, as an investor, you invest better, more wisely, more calm, more relaxed when life is simple. And trust me on this, having one ETF is lovely because you can just follow one ETF. It's dead easy. And because of that, it makes life easy. It makes you more healthy and happy. So you're more inclined to want to work hard and earn money to invest. And you're not confused by all the noise and all the different things you could do. They exist because they're businesses in their own right. There is no real difference. VT, QQQM, SCHD. At the end of the day, if you want the S&P 500, you need to ask yourself one or two questions. Do you want an actively managed fund or a passively managed fund? Long-term investing does not require an actively managed fund. Actively managed funds are there for volatility, for stocks that need to be constantly reevaluated and adjusted. The S&P is designed for long-term investing, and it's proven over hundreds of years, in fact, not just the few years it's been around, but hundreds in different formats, that long-term investing works the best. But everybody is entitled to set up their own businesses to try to encourage you to take part in them. That's kind of why all these things exist at the end of the day. Just like me, there are thousands of YouTubers doing what I do every single day, but I think I do it better. They think they do it better. So I'm trying to get your attention. They're trying to get your attention. We have different ways of doing it. I do it by going live and telling the truth. Others will do it with dramatic thumbnails and telling you the world's coming to an end. You decide which is right for you. I can't make that decision for you. So I wouldn't buy half a dozen ETFs. I don't see the point. If you want a rounded portfolio and you buy the S&P 500, VU would be my choice. It is my choice. That's why I own it. I've done this research. And if I wanted to amplify it with, I think Virgin Galactic's going to explode, or Nvidia or Tesla, I can buy a little bit of that. That's already maybe in my S&P, but it gives extra weight to it. I can do that. But there's absolutely no point. And another thing that is important, and this is a very key point, Warren Buffett often mentions, if you only could choose a handful of stocks for your entire life, which ones would you choose? You'd choose wisely. Being diversified doesn't mean buy everything. If you know what you own, you don't need to buy everything. I could actually buy Coca-Cola and just own Coca-Cola with $250,000 and have a nice income from that just by owning the business. I don't have to have anything else other than Coca-Cola to do nicely. So you don't have to have hundreds of stocks, because remember, if you have half a dozen ETFs with 500 in each, you've got flipping millions. Is there any point in that? No, I wouldn't do it. It makes life too complicated, too much to worry about, and investing is actually quite simple. People want it to be complicated because the more things you buy, and there's another thing to consider, by the way, if you have 5 ETFs and you buy into 5 ETFs every single day, and you spread your money across, your money is being lost in those microscopic transaction fees, which you don't even see. Robinhood say it's free. It's not free. You pay a slightly higher price, and it's micro pennies, but nevertheless, slightly higher price because they wholesale it out to a market maker. There are cheaper ways to buy the same stock. Doesn't matter to you overall, it doesn't really matter. But if you buy lots and lots of stocks, you're giving lots and lots of little bits to Robinhood. Who's the winner? Robinhood. The house, the brokerage, the casino, the house always wins. It's designed to get you to trade more, buy more, have more. If you just own one thing, you'll do just fine. At the end of the day, I started with $5,000. I earned no money on YouTube for a year and a half. I'm now at $250,000. I've got no options, no trades. No, I'm not in any trade right now. I'm just holding. I don't lose money. I got no margin. I got 34,000 in cash just by buying the dips. And I don't mean the dips. It's important to keep saying this. I buy with conviction when it's oversold. That V shape, I went all in on margin. That's buying with conviction. I don't need to buy to have hundreds of stocks. I don't need to be multi-diversified. I just need to read a balance sheet. And when the market is oversold, you buy with conviction. That is why I'm up, not because of having millions of different stocks. In fact, I only own VU. So there you go. The question that was given to me today from RC, which one? Should I have them all? No. You don't need half a dozen ETFs. People on YouTube will tell you you do, because the more they can sell, the more nonsense they can put out, the more people might watch, the more brokerages love it, the more the sponsors love it, the more the hedge fund managers love it. I know, I talk to them. But is it the right thing for you? No, it isn't. There's my opinion. Take that as you will. The facts are quite clear. My results are quite clear. Do as you do. Work for yourself or work for the fund. That's your choice. Who do you want the money to go to? You or them? Only you can decide. I've already decided. Click above my head for all the links down below in the description. Over here, my full playlist and all the stocks I've reviewed. This was a kind of mini review, but I'll put it in there. And down here, something else I think you will find useful. That's it from me. Until next time, as always, take care of yourselves and each other.